Okay, there we go. Take it away, Joe.
Great. Thanks very much. Good morning, David. And June the 12th. So rapidly approaching the end of the first half of the year. A bit of a commercial real estate update from Rockwood Cap. They are one of our bigger sponsors at about 34 billion. And then slightly smaller charts of the week deck here. Sounds like Andrew's going to be doing some traveling. So let's get into it. Okay, so Rockwood is based out of New York with offices in most of the major locations you'd expect. Briefly taking a look at Fund XI, which is either 9 or 11. I'm pretty bad at Roman numerals, but you can see sort of the quantum here. So this is about $1 billion in capital commitments. In terms of the portfolio composition, it's sort of let's just call it break even after some rental distributions. And the big issue here, and I'll point it out to everyone, is really product type and geography, and it's as simple as that. So we'll cover that off shortly. The speed to income looks like the bulk of it is kind of in place. Be nice to see a little bit more of it, but um, it is what it is. And then you're looking at about a third of it 2 to 3 years out. Um, the real sort of uh, answer to the question of kind of flattish performance is this chart here. So although they do have a lot of residential real estate. And by the way, this was not the case maybe 3 and 4 years ago. They were sort of traditionally into a lot of office product and that sort of thing. That residential increase happened, again, by my recollection, kind of maybe just before COVID, and it's kind of fortuitous that it did. Um, the the real story here, I think, though, is this geography chart, and why I say that is, firstly, it's obviously a lot of it's in the Northeast, and then secondly, when you go to slides 8 and 9, and you got to just, I'll just go back and forth here real quick. This is the NCREIF property index for the overall United States, including all categories of property type. When I advance to the next slide, so keep your eye on the minus 8.39. If you go to the next slide, I just highlighted the button on the filter to the US South, and you can see that area encompassing all product types is down less than 5%. So again, going backwards, negative 8.3 to negative 4.6 just goes to show you how much relatively stronger the southern economies are for commercial real estate. And then obviously if you focused on apartments and industrial relative to things like office product and retail, the results only get better and better. In terms of the individual assets, they're here, and there's sort of a range of fair value adjustments that have been made over time. We won't really go into much of these. There was a financing, which I'll talk about in a second, and then this is just sort of the second page, getting into again some of that office product, really sort of sucking wind compared to the multiples that you're seeing in other product types. And then the financing pertained to 4601 DTC in Denver. And in January, the partnership completed a loan restructuring with Citizens Bank, firstly extending the maturity to 28, and secondly, essentially taking the loan and chopping it up into kind of three separate notes. Along with that, sort of slice and dice program was an incremental equity investment of $3 million, funded in the form of a preferred share position over the new quote A note, and that's set at 78% of LTV. So that's kind of the way they're doing these now, and you're probably going to see more of them. This is a pretty big office tower, and as of quarter end, it was 80 80% occupied, but you're starting to get, a little bit more of these, let's call it more creative refinancings making their way, around the CRA space. And this is a nice building. Like if you dive onto Google Images or watch the video, it's really beautiful. And I grew up in the city of Mississauga, and some of the office parks in Mississauga and those areas are very nice, very beautifully landscaped. The buildings are big and clean and bright, but no one's there, and so that's sort of the risk you take with office product. So transitioning into charts of the week. So again, he's looking like he's taking some weeks off for the summer, so it's a little bit lighter this week, but right at the top, he points out that the 50-day moving average for the S&P 500 is now about 6% under the current levels. And so, he's suggesting that that could pull the index down, sort of in the absence of any sort of positive catalyst. So, sort of obviously a very major improvement in the economy or something more positive on the trade side, but um, he kind of points out that there's no real catalysts at this point. Um, it looks like stocks are kind of looking through it, and that is something he points out in the index of leading economic indicators, which is coming up in a few slides, is that the economy has been, the U.S. economy has been relatively resilient to the whole issue on trade and tariffs. I don't really know, to be honest with you, how much of these tariffs are starting to actually bite into consumer and businesses. Like I know we all get the headlines and stuff, but I guess the question is a lot of it happening? There's been some that have been uh, delayed and postponed and that sort of thing. So it's for now, it looks like stocks are kind of looking through it, and you can see in the last maybe 2 3 weeks we're still in between the second and third upper standard deviation band for the S&P 500. But again, this is sort of a higher altitude zone that can be potentially problematic for the S&P. Fortunately, we're hanging in there. Uh, Overall, I'd say the indices look pretty good, and it's really nice to see that Russell 2000 chart kind of peaking up there. He does talk about it sort of later on in a dedicated chart of IWM. The idea being that small caps were sort of last to the recovery. They were last to the recovery, but they also made up substantially more ground than the bigger indices, the bigger cap indices. But on the other hand, they also dipped down lower than most of the major indices earlier in the sell off in April. So we'll see how that goes. Oil has shown signs of percolating up here through the system, so that's good. We do have some energy holdings in the portfolios, and again, for kind of for myself and select other investors, that US dollar index, um, it is a bit of a headwind to just sort of navigate through on the downside. But again, when you're getting new monies coming in from um, uh, Canadians making capital commitments, you do have some potential you know cash on the sidelines, which is good. That NYSE advanced decline line looks really, really good. It's broken out of that maybe year long, well, not quite a year long range, but almost a year long range. So that's looking really positive. The NYSE percentage of stocks above their 50-day, as we said, is looking really, really good. And so is the NASDAQ summation index there. So from this particular slide, stocks look pretty good, and so it'll be interesting to see if this continues or if we're sort of going to peak out here over the summer and not do a heck of a lot. The biggest sectors moving or transitioning positions on a technical basis would be utilities and consumer staples. And that's really not surprising, excuse me, that's not surprising in this kind of more, I guess, risk on-ish tone that the market's having. You can sell off your utilities and staples and get into some of the higher beta, higher torque parts of the market, which kind of looks like it's happening. So the S&P 500 has an opening to trade to its all-time high. He doesn't really say it's going to get there. He says it may get there. Um, but right now the technicals, I think, from Andrew's perspective, are flashing more in the way of like an amber signal on a street light, like you can floor it and race across the intersection and hope you don't get that red light camera ticket, but it's not really a green light, so it's not rip-roaringly bullish. There is some little bit of divergence here on the part of um, the S&P 500 relative to um, not only its relative strength, which in this case he puts in the upper top panel. We're usually used to seeing that on the lower panel. So just to make that distinction clear, the lower panel this time is the percentage of stocks above their 50-day moving average, which again has done very, very nicely, but seems likely to be petering out here. So just a possible dislocation between the overall index itself and some of the momentum indicators around it. Okay, just talking about small caps, we do have a small cap investment in the hedge fund, and what he points out here is that the Russell did finally go ahead and hit its 200-day moving average, which is positive. It's good. It was the last of the major indices to sort of get there, unless you consider just the Dow transports as a major index, which a lot of people do, but some don't. And the issue here is that the Russell is also nearing this 61.8 percent Fibonacci retracement zone of its November to April 30% loss. That was a bumpy ride. And it could be the case that it sort of depends how you look at it. Small caps, were last to get to their 200-day, but they had the most to distance, let's say, to make up, and they did. Um, and so I think, to summarize, he kind of points out stuff, I guess, that we would kind of already know. Like we already know what small caps have done. I must say he doesn't offer that much insight into, what small caps are likely to do going forward. Um, but we've come back a bit, which is positive. And then the Fed funds rate has been pretty stable here. And I think what he's saying is that the recovery in the stock market and the sort of overall um, resilience of the economy to some of these issues around trade um, have really had the short-term market rates in this very, very narrow zone, suggesting that um, either investors don't believe that the Fed is going to blink and start cutting rates just because of what Trump is doing, or because they believe that he's simply trying to get a deal and willing to make concessions. So the story around what is a very flat and stable Fed funds rate has a very diverse range of views and theories. But the bottom line is it's resulted in the Fed being on hold. And there is sort of a rumor. Someone called me up the other day to say that Trump is going to try to put Scott Bessent in as the um, head of the Federal Reserve. Obviously, I mean, there's lots of rumors going around the world, but that is one of them that I've heard. And then finally, the index of leading economic indicators has fallen for the fifth consecutive month in April. Um, you got to be careful with some of these indices, because I think that, and we talked about it maybe a couple of weeks ago, was that, the April auto sales in the United States were fantastic. And this was because of all these tariffs coming in. And so a lot of people that, maybe were thinking about buying a new vehicle bought one anyway. The problem with that sort of line of thinking is that, if you go out and buy a car, or whatever. And it doesn't matter what you're looking at. Everything with four wheels is expensive these days. If you go out and buy a car, 1 or 2 years before you had planned to, A lot of those, trips down south or concerts or sports events or trips to the restaurant probably are going to get put on hold. And so it does kind of compress or sequester spending to other discretionary parts of the market. And I think that's it for myself. So I'll stop sharing and pass it back. And Ken, I guess if you're um, ready, if you have any information you'd like to share, go ahead. Otherwise,
Yeah.
oh, great, perfect. Hey, Ken, good morning.
Morning, Joe. Let me just pull this up. Okay, so same disclaimer as Joe on the front end, so I'll be quick here. Just contact us today. Just go through this pretty quickly. Looking at the S&P, $2 increase, new buy signal, second straight. So really starting to break up to the upside there. That's the first time that's happened since before the election. Obviously, there's China-US trade deal optimism from the framework that was set this week, so we'll have to see what happens there. It does really seem like the market is acting or not reacting to Trump and Trump's administration as much, but it seems some of the policy making decisions are a little more, we'll say, thought out, but maybe that will end in July when the next tariff deadline ends. Looking at the Nasdaq here, $2 increase week over week. It's $1 away from its all-time high in resistance. So after that huge dip down, we got into the low 16,000s for this Nasdaq 100 chart. We're within spitting distance of that all-time high. The weekly overbought, oversold 62%. That's the seventh straight week it's been overbought. The strong technicals are continuing to improve for the Nasdaq, so we'll have to watch that. And then looking at the Dow Jones, a little increase this week. It returned to a buy signal for the first time in a month. So something to have note there. Some nice strong support lines all the way down to this trend line. So really some downside protection there. And then price objective all the way up to 46,000, which was a complete reversal. So it seems for now the value is, or excuse me, value stocks represented by the Dow are heating up slightly on a relative basis. TSX 60, $1 increase to all-time high here on this chart. The nearest support is all the way down here, 21 boxes lower, which was basically at the bottom that we saw in April. We've seen a rebound of about 200, 250, 270 points for the TSX 60, so something to note there. Obviously, Canadian equities continuing to perform very strong. I think the index is up 7 to 8% now year to date. Some of this outperformance for the Canadian market due to valuation, due to being more heavily weighted toward commodities, which have performed really well this year. But we had mentioned last year we were waiting for a TSX breakout, and it seems we might be on the precipice of it, and it would be a positive sign for now if the TXX could reverse backward and then continue higher to create some short-term support. Nonetheless, looking at these technical indicators, obviously the VIX, a little bit of a breakdown this week, second straight sell signal, first time that's happened in a month. So something to have note there. Target decreased to 12.5%, which is the lowest in a few months by my memory for a target price. The bullish percentage charts, neither of these have moved. Both relatively elevated. The S&P did reverse last week, so we'll have to watch that. NYSE still some more upside relative to last year's levels. Looking at these percent positive trends, the Nasdaq actually broke out to a 1-year high at 76%, which shows the bullish nature of investors in their mindsets when looking at tech. So it seems really like retail is pushing risk back on through the proxy as the Nasdaq. Looking at the Dow right there, well below the highs that we saw last year, but just entered that bullish territory line. So that 70% level, we'll see how long both of those indices can hold those. And then the Toronto Stock Exchange, bullish percentage chart moved up another 4%. It's moved up pretty heavily over the last 8-9 weeks. It's 1 box away, 2% away from being at the highest point since November of 2021. So really a multi-year high, some real strength in the Canadian equity market, and the technicals are backing that up. Looking here at the asset class rankings, international equities and commodities picked up a couple buy signals. International equities also jumped a position here, really being driven by the European markets, both emerging and developed. There's still some weakness in Asia and in select Latin American regions. Obviously, we've mentioned Mexico's been very strong for us this year, but the European emerging markets continuing to be the strongest performers this year. Think those Eastern European countries, maybe some of those Southeastern nations as well. Really seeing strong returns. I saw Greece is up in multiples over the last 6 to 8 months. I think it was 30 to 40%, something like that. And the PE ratio for the overall index is still at about 9. So if you're really extrapolating some data, you could push for an even higher upside target for some of those regions. This is just the Dorsey Wright chart on the summertime returns versus the rest of the year returns for the S&P 500. You can see the data since 1990 and then the data since 2010, obviously. Kind of go away during the summer. The rest of the year produces the majority of the returns. Still kind of rings true in the recent decades, but you can see some larger returns in terms of the average and the median compared to data that goes back all the way to 1990. So something to have note there. And then just highlighting a couple charts. I'll be very quickly here. Excuse me, very quick. Emerging markets ETF really is the one I wanted to highlight as we have some holdings there. It's been a bit of a whipsaw year and a half, 2 years of us holding this back up to a multi-year high, which we're really happy with, and really a nice bounce off that bottom. However, there's no support lines of note. A lot of the equities within this region or within this ETF still trading well below their historical average price to earning ratios, but also relative to some developed markets across the world. And we think there's still some upside, obviously, in the emerging markets region, especially if a trade deal between the United States and China is reached and the impact is very minimal. Looking here, this is the US dollar, created its fourth straight sell signal. I mentioned this last week in a different style chart, but just wanted to highlight the classic Dorsey Wright point and figure chart. Still down 9% year to date, and you can see it's at the low it was at when the markets were basically bottomed in April, after we got those kind of, we'll call them flash crashes, even though I think at the most the market was down 10 to 12% off all-time highs. But you can see if it breaks below there, there really is no downside protection. So we could continue to see the US dollar break down on a technical basis. Just wanted to highlight a couple charts here, or excuse me, headlines for uranium. I haven't mentioned this in these calls in a long time, but we've talked about it in the Weekly Beacon and continue to run our own research on a number of names within the nuclear energy space. But over the last month, 3 weeks, I can't remember this many bullish headlines and announcements by companies and governments around the world, and which is just going to boost the demand case for uranium, where there really doesn't seem to be any extra supply coming online. But you can see, obviously, Trump continues to be bullish on nuclear energy. The biggest one, I think, is right here. Berlin kind of seceded to France to overcome their rift over nuclear energy, to use nuclear energy as clean energy finally. Germany was kind of the longest holdout in that case. And then obviously the tech firms like Meta and Amazon spending billions of dollars to secure multi-year contracts with nuclear energy providers. And with that being said, just highlighting the Sprott Trust, obviously down this year. It's kind of had a bad 17 months or so, 16 months after peaking out after that huge surge to end 2023 and start 2024. But nonetheless, the NAV is approaching premium for the first time in a couple of years, which is a really important thing to watch. The price target is pointing downward, but we think for now there is a bit of a floor to the price in the physical market, and it seems like that's in the $60 range. Well, we'll have to see if we do return to that $100 plus spot price range, which we briefly saw during this time. But for now, that doesn't seem very likely. Looking here, uranium miners, obviously, it's performed a lot better than the physical Sprott Trusts. Scores at about a 4.5 out of 6. It's up four and change the year to date. Price target points upward a little. It's been overbought the last 6 weeks. You can see the real move it's had over the last 8 weeks or so from the market bottom. It's up about 33, 35, 36% just over that time, maybe a little more, 40%. All right, just can't really see the numbers there, but nonetheless, we remain bullish on a lot of these miners. Obviously, we don't own the overall ETF, but it was just a good proxy to represent the entire space. And with that being said, I'll pass it back to Joe or David.
Yeah. Okay. Let's go to good. Yeah. Let's find the keep going. And there we are. The S&P 500. We'll just look at the three indices. They just continue to be recovering back towards their highs. Let me. Can you just bring this down just a little bit further? I just wanted okay, where's oh yeah, there we are. Okay, good. I just wanted to show that light blue, very light blue dotted line. That's the fair market value of the S&P 500, and so the index continues to trade above. So that is always a little bit of a concern as far as we're concerned. But anyway. I keep wondering if the index is going to recover all the way to its peak valuation there, which would be what we call the low super growth rate, but 4.5 times adjusted book value, which was the high of the market in 2000. Back in 2000, actually, the S&P bumped up against that level for pretty much a solid year before it really started to let go in 2001. This year we had an early smash, but it looks as if it's maybe recovering back to that peak again. I don't think will be able to get through if it does, but nonetheless, there we are. And the next chart is the Nasdaq, and it too has broken out over its very, very recent high. It too looks as if it may be heading towards its very, very long-term peak, which is what we call the HB1, about well, it's 9.5 times adjusted book value. Probably call it 10 times book, something like that. Whether it'll get there or not, it's an interesting question. And again, look where the fair market value is. The blue dotted line there is a long way down. So people better continue to be optimistic towards this index and the stocks in general, because the history of the Nasdaq shows that there is a powerful tendency to revert to its intrinsic value, and as you can see, that's quite a way down. And the next chart that I want to look at is the TSX, and as we have been saying all the way along, the fair market value there is well above the current index, and there has been really after that setback when all three indices set back, the TSX has been actually the strongest, I think, of the three, and continues to hit new highs, and so it should, I think, because the values are there. Anyway, that's all I I think I really want to say, unless Gilbert, you want to come in with anything.
No, that's all right.
Yeah. Okay. So anyway, kind of steady as she goes, Ken.
Awesome. Thanks, Ross. And Gilbert. Ms. Curry, did you have anything to share this week?
Yeah, thanks, Ken. I guess we're getting a bit of a rally in the rates market with some below expected results on the CPI and on the PPI this morning. I think people were probably set up for the impact of tariffs to show up on the inflation data, but it hasn't as of yet. And so I think that's probably, resulted in a short covering rally. If it was possible, I'd love to generate a discussion on the Canadian dollar here. It just continues to sort of, rally, on the back of, I guess maybe it's oil prices, Canada being a petrocurrency, but the interest rate differentials between Canada and the US are quite striking. So, I'm not sure the magnitude of the percentage terms of the rally in the Canadian dollar, but, it's for those of us who hold US assets. Yeah, it's certainly concerning because it's taking away from performance. So, maybe I'll turn it back to you, Ken, on that open question. If you could moderate that for me, please.
Yeah, Chris, it's Ross. I we are I think somewhat of the opinion that it's not the Canadian dollar that is strong; it's the U.S. dollar that is weak, and that's because the solvency condition of the U.S. economy is not only poor, but with the big beautiful tax bill, or they're calling it nowadays, if that comes into effect, it's going to affect the solvency condition of the U.S. even further, and push it down. And price follows solvency, and if solvency is declining, the price of the U.S. dollar is going to go down as well. So that would be our view: less Canadian strength and more U.S. weakness.
Yeah, you can certainly see that in the the DXY, or they call it the Dixie. I think the composition of that has a big component of euro. So the U.S. dollar euro cross is certainly in the euro's favor for sure. Yeah, no, good point, Russ.
Yeah.
I guess I find that in the world economy, Canada is such a small component of that I just don't see people rushing to the Canadian dollar as a safe haven. But maybe you're right.
No, but they do they do look upon our leadership, I think, very favorably, and Mark Carney is really making his mark, and in terms of confidence in Canada, I think thanks to him, that probably is at the margin. I think it's probably helping.
Yeah, very true. Yep, good points.
Yeah.
And just looking at the breakdown of the Dixie here, it's 58% Euro, 14% Japan, 12% Great Britain, then Canada at 9%, Swiss at 3.6, and Sweden at 4%. So yeah, the euro is certainly the major component of that index.
Yeah, just to follow up, morning guys, to follow up on that vein of thought. I mean, I agree with you 100%, Ross. It's nothing more than the falling of the U.S. dollar, right? But what has become clear is that Trump, may have campaigned, and maybe people were just hoping that there might be some, common sense brought to the way the U.S. Fed is currently spending, right, to rein it in a little bit, because it's been, with Biden, it was excessive, right? Excessive deficits. And now it is abundantly clear that the whole Doge initiative and stuff is going to be small in comparison to the amount of money Trump wants to spend. And so it's really over, right? For the next 3 years, we're going to have huge deficits in the U.S. And I think that's just, it's all about fiscal responsibility. And Trump doesn't seem to really care. And so what of all those currencies Chris just listed, which one do you want to be in?
Well, I mean, he's bankrupted a number of his own enterprises. He might as well bankrupt the biggest enterprise of all, which is the U.S. government.
Yeah, that's the thing. He just doesn't seem to really care about debt or deficits. He's just, and I think that's the real reason, Musk started fucking yelling at him, because it's clear to anybody with a high level of intelligence that America is on a fiscal path, death spiral potential, right? And whatever the debts are now, that's not the issue. The issue is 5 years from now. How big is this going to get? And we're going the way of Japan.
The forecasts are pretty ugly.
They're really ugly, and it's not even clear how you're going to finance this. Well, actually it's not. It's very clear how you're going to finance this. The Fed is going to end up buying U.S. Treasuries, right? The Fed is going to finance it. So it's it's just a crazy situation, and so Canada, relative to that, is Canada going to go spend themselves into bankruptcy? Likely not, right? And we'll see with Carney, right? So the Canadian dollar gets a bit of a lift. It makes some sense, right? No matter what else, Canadian dollar's probably, good for, it's been down so much that it's good for a bounce, right? And so it's I think it's very clear. You need to buy hard assets. The only thing that's going to protect investors from our government's folly is you need to get out of bonds, and you need to get into hard assets. That's it.
Yeah. In the meantime, Canada has been issuing U.S. dollar bonds, which is brilliant, because those U.S. dollar bonds are falling in value. So translated into Canadian, and the buyers of the bonds, well, they simply get hurt by the exchange rate.
So what do you do as an investor? I mean, you have to acknowledge that this is not going to change. It's just not going to.
I have to interject there, Paul, with the food for thought. I mean, we do have the big spending package from the U.S. coming into the economy, and that's going to be, rocket fuel for corporate earnings and the stock market. And
right.
I think Trump's hope is that people are going to look at the, proposed economic growth from the spending and the feel goodness that generates from rising and allow him to maybe gain share in the midterms. But, I think, now we're in that kind of a lull period where we're, nothing really to look at, talk about, and the deficits, at the forefront. But I think wait until that spending hits, and it's going to hit the economy hard.
What's that going to do to deal with the debt, right?
Yeah, I think the
Stock market
debt's
could go
going to
up.
fade.
Stock market.
The debt, I think the debt concerns will fade as earnings increase, stock prices increase, as the market levitates, unemployment goes down. You know,
Yeah, but what
you know,
is that? It still doesn't address what we're talking about.
no, but what I'm saying is it's going to
Stock
fade,
market will go
right?
up. No,
We've had
stock market
deficits for 40 years. You know,
okay.
this issue's been on the table and it ebbs and flows. And, you know, I think it's going to ebb in the fall when the spending kicks in.
Well, all you're saying is going to happen. Okay, the stocks are going to go up. The Dow's going to continue to rise. It's good for stocks. It's not good for bonds. It's not good for currencies. It's not good for the U.S. dollar. This debt it's not going away. There's no plan to repay it. If he just didn't do tax cuts, if he just stopped the tax cut idea, people could argue that we're on a track to growing out of this problem. But when you add tax cuts to overspending, you're just throwing up your hands saying, I don't care. I'm going to go deficit spending. I think that's what is so obvious today. And when is it going to stop? And just because everything goes up in value doesn't mean you're going to pay down your debt or balance your books. So and his entire career, he's never balanced his books on anything. So
well, let's diarize to have this conversation next November, and we'll we'll see what our what the current topics du jour are at that time.
But it's not really like that. It's not really like that, guys. It's just numbers. Okay, the tariff revenues. Okay, now that you know more than you did 2 months ago, and you know the tariff revenues are not going to be, monumental. They're going to be interesting, good for the U.S. government or whatever. But these aren't big enough numbers. And then you know what the tax cuts are going to be, right? That's clear. These are significant numbers. And then you know what his spending forecasts are, and these are huge numbers. So you already have the answers, and the market's speaking. And so I think it's not political. It's just it's financial, and I'm not sure it's not clear to anybody who wants to pay attention. And John Paulson, I mean, he wanted to the smartest guys in America. John Paulson is going all in on gold. He's taking his entire fortune and betting big on gold. Okay, this guy's as smart as you can get, right? And so he's not buying bonds; he's buying gold. So he's gone 80%, right, of his family office is invested in gold equities. So he's looking at the same numbers we are. So I don't think you have to get political about this at all. You just have to recognize who's in charge and what they want to do. So look, the deficits are huge. So how are you going to finance it? And that's what the market's going to have to deal with. So it is what it is.
Yep, that's a good place to conclude. It is what it is. Everybody knows what it is, and
well, just to go on an optimistic. I'm not trying to be pessimistic or anything. It's not it, guys. Okay, so what's happening right now? Silver broke out right 2 weeks ago. Silver's gone through $36. Gold just touched 3,400 today. Palladium and platinum are moving, as are all these other base metals. They're breaking out right now. So these are huge opportunities because, you can synthesize the most undervalued cash flowing part of the S&P is gold equities. They're the most profitable companies now on the S&P, and they trade at the lowest multiple. So go buy some gold stocks because they're just cheap. And they're doing well, and they're all breaking out, but they're still cheap. So you take the mid cap gold equities right now, and there's 15 of these companies, not that many, but there's a good dozen to 15. These guys have cash flow yields right now, currently at current spot prices of like 25%. So shareholders are getting 25% cash return on the valuations today, and that's amazing. It's record setting. So these things are cheap. So lots of chance to make money in this space. And then I met with. I'll just leave you with this. I met with this fellow Mike Gentili on Monday. A big, it's like a junior Eric Sprott, right? He finances all sorts of equities in the resource area, and he says the correlation between silver, the poor man's gold, and small cap stocks. If you go back over 50 years, when silver does well, small cap stocks, particularly in Canada, do very well. But you go to the U.S. as well. So the whole small cap area, and you can see the Russell 2000 or the 3000 has broken out as well, and looks great technically. So we're entering a phase where stocks, the smaller cap stocks, are probably very highly likely to outperform, and
Paul,
so that's good too. Yeah.
Well, is what you're saying mutually exclusive with what Chris is saying? Because isn't it entirely possible that we can have, this bill sort of result in growth doing really well, while at the same time you get everything that you're talking about do really well as well? I mean, it could be this sort of melt up. I mean, David, or I don't know if David's still on the call, but David Hunter has been saying that we're going to have this melt up where everything is happening, and I'm not necessarily a fan of David Hunter, but I don't think that what Chris is saying is incongruent with what you're saying. We could have something like that.
Yeah. The Dow's going to go to 100,000.
Right.
Yeah, that's what's going to happen because the Dow's not the government's, right? It's corporates, and so yeah, for sure. But what's not going to go well is certain asset classes are not going to do well, and the number one that's not going to do well is bonds, right? So John Paulson doesn't buy bonds, right? And bonds aren't safe because you get your 5%. Go buy a U.S. Treasury or whatever, a 2-year Treasury. How much money are you getting? Well, whatever you're getting, the government taxes half of it, and then inflation takes the other half. So you're basically not getting anything. And sitting on cash, people say that all the time. Oh, I'm sitting on cash. I'm very conservative. I'm sitting on cash. Well, what cash are you sitting on? Yeah, you need to ask yourself that question, because if you're in the wrong cash, you're gonna lose money, right? And so yeah, those two components, which are huge components of most portfolios, these two components are no longer going to do very well. And I'm saying for the next 3-4 years, it's pretty clear. And so what do? Well, you just get yourself invested in something real, and you'll do fine. And it's so easy to do now, right? I mean, people talk about owning cash. Well, you can buy a gold ETF it takes you 5 minutes to buy it, and then you can sell it in 5 minutes, and you can turn it into cash in 5 minutes. So like, what? Just don't have a bank account with $100,000 in cash in U.S. dollars. Just put it in gold. Put it in a gold ETF. And I think you're just going to do so much better. And it's happening. And I think that's the message I'm trying to say, is it's all very evident that this is the way the world's going. And with these two new governments just being newly elected, you've got a sort of a 3 or 4 year window here of the future. And